following yesterday's meeting, that selling continuing today. We will discuss all of it with the investment committee, including star fund manager Glen Kacher of Light Street. He is with us exclusively right here today, and we're excited about that. Also joining me, Josh Brown, Jenny Harrington, and Jim Lebenthal. Let's first check the markets, as we always do. It's 12 noon, of course, in the East, and we are red across the board. Not yields, though. They are up today, so stocks are selling off. Rates are jumping to fresh cycle highs. We're really zeroing in, though, on what's happening in the NASDAQ. It was down about 1.5% right after the Fed decision. It's down yet again today. It begs the question, can the tech trade still work in a much higher for even longer market? Josh Brown, take that first. What do you think?
I think the tech trade is going to struggle so long as we see rates moving higher. It's nothing new. This has been the reality that we've been living with. When you get these spikes, especially at the longer end of the curve, obviously everyone's discounting mechanism, and you see volatility spike up. So that's where we are right now. Longer duration yields are moving, Judge. 10-year up 13 basis points, 20-year and 30-year, as you mentioned, both up, hitting cycle highs, highest since 2007 on the 10-year, 2011 on the 30-year. The dollar plays into this as well. The dollar is now at its highest level since the SVB crisis, up about 2% on the year. If you remember, the dollar hit its low in the middle of July. 2 weeks later, the stock market peaked, at least for now, for the year. Ever since then, you've had a dollar rally, and that doesn't work for stocks either. So now you have the Dow down 4% from that moment. You have the S&P 500 down 5%. Qs are in a 6% dip. And the Russell 2000 is in a literal correction. It's off 10% from that level. And it's not a coincidence. This has been an inverse correlation that we've been documenting all year, and it's just what it is. So I think now we're going to all furiously debate whether or not there's another quarter basis point rate hike in November. Personally, I don't think it matters all that much, but to the market, it clearly does. And you're just seeing repricing of risk. I think it's perfectly natural. The VIX is now 16 or so. That's the highest level that we've seen since August. And, you know, that might not be done at 16. So I think we all have to just be okay with, we had a great first half of the year, and this is a little bit of give back. September is sloppy, and this year is no different. So,
Glen Kacher, I mentioned it's nice to see you. Welcome back to our program. You are all over the tech trade. For certain, if you look at your holdings, NVIDIA, GitLab, Meta, Tesla, Alphabet, Taiwan Semi, Salesforce, Microsoft, AMD, Amazon, do we have a problem now with tech by virtue of what happened yesterday?
I don't think so. I mean, as an investor, you're looking to invest in trends that you think are going to outpace whatever headwinds might be in front of you. This is a normal correction. We see corrections every year. We've had, the Fed information come out just here yesterday and in previous weeks. And, we don't ever expect to invest and get a straight line up.
I mean, it's virtually been a straight line up for let's say, the mega caps, the Magnificent Seven this year. I mean, the gains have been pretty astounding, but in a much higher for far longer environment, doesn't the tech trade struggle?
Well, I think if I'm looking at it and trying to handicap it, we're investing behind an AI build and a change in the dominant computing architecture that's going to go on for a decade or possibly much longer than that. And so when you think about some of these applications, whether it's Microsoft's Copilot and what they can do for the efficiency of a programmer, and globally, the salaries of programmers that's a $1.4 trillion value capture or value opportunity to make them more efficient. We're talking about tremendous long-term opportunities here, and I would bet that the opportunities we're investing behind when we're investing in technology and the AI opportunity, that's going to outlast any short-term correction and any worries about the Fed in the near term.
So we'll get obviously to more of that. But Jenny, how would you entertain this question? I mean, it becomes a trickier market. Dan Ives suggests that tech stocks can rise in a higher for longer mandate. He says yes is his answer, and he gives you all the reasons why. As I suppose you would suspect to hear from him. But there are some who suggest that by virtue of what the Fed did yesterday, which was somewhat surprising, at least leaning for taking some cuts away and being in that much higher for far longer stance, that you have rates higher and then you have the risk of a recession rising as well.